Today, we're diving into an investment analysis on BigBear.ai, or BBAI. It's a bullish take for 2026, arguing the company is about to hit a major inflection point, driven by a key acquisition and a huge pile of cash. Okay, so let's get right into it. A core theme, maybe the central theme, is this massive $456 million cash pile. It's positioned here as a financial safety net.
Right, a safety net. And that's a solid starting point. But I think to really make this analysis sing, you have to transform that cash fortress from a passive safety net into an active, strategic weapon.
I see what you're saying. A safety net is defensive. It stops you from losing, but it doesn't really help you win.
Precisely. And that's the weakness. The analysis treats this cash hoard, which is almost 20% of the market cap, by the way, purely as a cushion. For a sophisticated investor, that can actually be a red flag.
A red flag? How so?
Well, it raises questions about opportunity cost. Is that capital just sitting there earning next to nothing? It can suggest, inefficient balance sheet management if the deployment plans aren't really concrete.
So it's mitigating risk, but it's not actually accelerating the thesis.
Exactly. It's not fuel for the rocket ship that the rest of the report is trying to build. So the suggestion here is to strengthen the argument by explicitly linking that capital to the aggressive 2026 growth forecasts.
You mean that 30% revenue acceleration number?
Yes, tie the cash directly to that. And also show how it helps them avoid equity dilution for future investments. You need to frame this cash not as padding, but as high-octane fuel for growth.
Okay, that makes sense. Let's make it concrete. What are a few practical ways to show that capital being deployed in the report?
Okay, first, you can frame it around the M&A integration. Use the cash as hard evidence that BBAI can fund the integration of both Ask Sage and Penguin completely internally.
Ah, so it removes the integration financing risk.
Completely removes it. That's a huge de-risking event for the whole thesis. It shows real balance sheet strength and, frankly, management independence.
That's a strong point. But couldn't an investor argue that spending that much internally just shifts the risk from financing to, execution?
It could. And that's where the second strategy comes in. You show how the cash enables BBAI to bid aggressively on new, large-scale contracts without needing to take on debt.
Like a Malaysia Aerospace City deal mentioned in the notes?
Exactly like that. Or the Heathrow partnership. The analysis should give specific examples of how that cash lets them underwrite risk or offer better terms in these huge competitive global deals. The cash becomes operational leverage.
Okay, so it's not just for internal use, it's a competitive tool. What's the third point?
The competitive landscape. You have to contrast BBA's cash position with its sector peers. Show how it gives them a superior ability to, say, weather an economic downturn, or even better, to quickly acquire a distressed asset in a volatile market.
So the cash gives them options that their competitors just don't have.
That's it. It shifts the cash from a static number on a balance sheet to a dynamic strategic advantage.
Okay, reframing that cash from defense to offense really sharpens the whole argument. Let's move on to the growth catalyst itself. We're looking at the Ask Sage acquisition. The analysis makes a very strong case that this roughly $250 million deal is the key. It's projected to add about $25 million in ARR in 2025-26, which is a six-fold increase over Ask Sage's 2024 revenue.
And that is the absolute core of the thesis. It's also where you're going to get the most pushback. The projected 6x revenue increase from Ask Sage, it requires a lot more de-risking to overcome the natural skepticism that comes with a number that high.
A 6x jump is a massive number in any industry, but especially in the government sector with all its red tape.
Exactly. The weakness here is that a projection that aggressive immediately makes an investor think about integration risk, about monetization speed, especially with something like FedRAMP high compliance, which is a huge lift.
So the report right now kind of assumes a perfect execution.
It does. And that can actually undermine the credibility. It can sound a little too optimistic. So to make the outcome feel more believable, you first have to acknowledge how difficult the goal actually is.
So if $25 million in ARR, the analysis needs to get much more granular on the how.
That's the key. You have to bolster this section with specific, logistical detail on how they're going to achieve that velocity. And, just as important, you have to differentiate between BBI's older, lower-margin work and this new, high-margin software revenue from Ask Sage. The quality of the revenue is a huge part of the story.
Okay, let's talk about those mechanisms. How do you make that ramp-up seem not just possible, but probable?
For starters, instead of just stating the ARR goal, you explain the growth mechanism. You do that by mapping the acquisition directly onto BBI's existing client base.
You mean like the US Navy or other government clients they already have?
Yes, you frame it as an immediate cross-sell opportunity. The growth is coming from expanding existing relationships, not the much harder work of finding brand new customers. That immediately makes the ramp-up look faster and much more secure.
That's smart. Leverage the access they already have. But even with existing clients, a complex platform like AskSage, it still takes time to integrate, right? Especially with the security requirements.
It does, and that's a critical point. It's why the second focus has to be on the quality of that revenue. You need to hammer the point that this is a shift to high-margin software.
So the argument becomes, even if they miss the volume target by a little.
Exactly. Even if they miss it slightly, the profitability surprise that's mentioned, that $2.5 million in net income, that provides a margin cushion for any execution risk. The market, you argue, will reward the superior quality of the revenue more than it will punish a minor volume miss.
So you're signaling that management is optimizing for profit and stickiness, not just a big top-line number. Okay, and the last piece to de-risk that 6x growth.
You make the target look structured. Introduce a phase projection. Don't present the $25 million ARR as this one giant high-risk leap.
Do you mean break it down by quarter?
Sort of. You introduce clear milestones. Maybe Q1 2026 is an integration milestone, Q3 has a deployment target, and then you have the full-year ARR goal. It lets investors track progress and moves the focus from if they'll hit the goal to are they on schedule.
Phase targets, cross-selling, and leading with revenue quality. Yeah, that really does de-risk that core catalyst. Okay, last point. Let's talk about the near-term weakness. The analysis notes that revenue dipped year over year because of, quote, contract timing, but that this will reverse in 2026 when AskSage layers in.
Right. And that structure is a bit of a rhetorical problem. To improve the flow, the analysis needs to proactively neutralize that short-term dip before it pivots to the bullish 2026 story.
Because if the first thing a skeptic sees is a revenue dip, they might just stop reading.
Exactly. The report mentions contract timing, which, let's be honest, is a classic bear talking point. It sounds vague, like an excuse. It's glossed over too quickly, and that allows a reader to just latch onto that weakness right away.
So we need to reframe it. Not as a failure, but as a deliberate choice, what you called an intentional cleansing.
Absolutely. The suggestion is to reframe that year-over-year dip as a calculated, strategic move to shed lower-margin consulting work. They're accelerating the transition to the high-margin, scalable software model from AskSage and Pangolin. It shifts the perception from financial weakness to managerial discipline.
That's a powerful reframing. But how do you make that believable? How do you make sure it doesn't just sound like corporate spin?
You use the numbers. First, you directly integrate the discussion of the revenue dip with that profitability surprise, the $2.5 million in net income. You argue the company is consciously choosing higher margin, which is high-quality revenue, over simple top-line volume. You show the trade-off.
Okay, so you link the strategic choice to the financial result. What about the bigger picture?
For the second point, you use the major international deals as context. The Malaysia Aerospace City deal, for example. You use that to show the company's focus is shifting away from, lumpy, older U.S. defense contracts.
So those legacy contracts weren't lost, they were strategically shed.
Precisely, because the focus is now on these bigger, global, more scalable opportunities.
And finally, you use the market's own reaction to validate this.
The technicals? Yes. Emphasize that the stock's technical breakout above that $6 level shows the market is already looking past the dip, is looking toward the integration story. Technicals often show that the smart money sees the fundamental business model shifting before the quarterly numbers fully catch up.
Using that technical validation is a great way to reinforce that the market already agrees with this strategic shift.
Yeah. I think the underlying analysis here is really strong, but